Okay, now that we've learned a little bit about risk and reward, let's put it on a continuous scale and see if we can apply it a little bit. So in the previous example, we put rewards on the vertical axis and risk on the horizontal axis. We started with low rewards and went to high rewards, and low risk to high risk. So we have a continuum here. If we start with, say, government bonds, which are low reward, low risk, and we move up in a combination of a little bit higher risk, a little bit higher reward, a little bit higher risk, a little bit higher reward, we can plot the investments that are available to most investors along this line. So government bonds, then we go to, these are federal government bonds, and then we go to state and local, which is called munis, and then we go to corporate bonds, and we go up to, say, dividend-paying stocks, and then we go up to, say, growth stocks, and then we go up to maybe junk bonds, and we go up to penny stocks, and so on, to very, very risky investments. So if you think of all of the investments that are available to you on a continuum, comparing the rewards that you might get, high or low, to the risks you might take, high or low, you can find a line that is basically increasing higher risk, higher reward over the continuum, and you can see which particular investment type that you're looking for. So if the rewards are high and the risks, then the risks are going to be high. So think of it in this terms. If somebody comes up with a company that is trying to find a cure for cancer, the odds on them finding a cure for cancer are very small, so the risks are high. But if they did actually find a cure for cancer, the rewards would be high as well. Well, the same thing's true on the opposite end of the scale. Government bonds are very low risk. They're very low risk because the government has the ability to pay you back, and therefore you're going to get your money back. They're going to give you back the interest that they promise you. There are other risks involved in them. We'll get into that in a different video. But they're basically on a continuum, or they're basically in the bottom of the continuum from low risk, low reward to high risk, high reward. Now, here's another way to think about it. Oftentimes, investment salespeople, financial professionals, will promote high returns in their investments. They'll suggest say a mutual fund or some sort of investment scheme that promotes high rewards. Well, that's obviously very attractive. The more high rewards we get, the happier we are. However, you need to continue to look at risk in a function of reward. So if they promise high rewards, then you should be thinking immediately, where's all the high risk? If they don't mention risks, it's because they don't want you to think that they're up here in the risk and reward scale. They want you to think you're down here. But you're not actually down here. You're actually up here. You're high risk and low reward, or high reward, low risk. Well, this isn't available. This is what they want you to think, but they're actually out here. You're missing the move from high rewards to high risk. So it's common to suggest investments that are high reward and focus on the returns of the investment, the past portfolio performance, the past mutual fund performance, etc., and thinking that, wow, they returned all those rewards, I want those rewards, and think only about the rewards. Well, if they're getting high returns, it's because they're taking high risk. There is risk involved. Either that or they're getting them over a long, long period of time through compounding. But anything that is short term that's high reward is high risk. Think of it as a lottery ticket. A lottery ticket, the odds are significantly against you. There is high risk that it will not pay off, but the rewards are stellar. If you win the lottery, it's fantastic. So the risk and reward relationship is important, that you don't mislead yourself or have someone else mislead you into thinking that there is a high reward, low risk investment when it's actually a high risk, high reward investment. And in fact, oftentimes it's exactly the opposite, is instead of being high reward, high risk, it's actually low reward, high risk, and your investment that you thought was over here is actually down here, low reward, high risk. And that happens quite often. If you chart some of the results of some of these risky investments, penny stocks, junk bonds, etc., they often end up here with very low rewards on average, but they are very high risk. And of course, we want to avoid this box because this is low reward, high risk. Avoid this one as much as you can. So anybody who's touting an investment that's up here, you start thinking, well, why isn't it down here? And where are the risks? Just because you can't see the risk doesn't mean it's not there. It just means that you haven't found it yet. So a risk that is an investment that sounds risk-free, if you can't find the risks that are involved, it's not that they aren't there, it's that you haven't found them yet, and so you don't really truly understand the investment. Also, if you think about this in terms of someone giving you financial advice, if they aren't talking about the risks involved in the investment, then you need to either shy away from them or you need to bring it up so you understand fully the risks. The risk is at least as important as the rewards, and if you don't understand the risk or nobody's talking to you about the risk, then you can't bet on the rewards because they move together. So think of risks in terms of rewards. Think of a continuum of low risk, low reward to high risk, high reward, and make sure someone isn't misleading you to believing it's high reward, low risk when it's actually low reward, high risk. So think about those in terms of making your own investment decisions and how you deal with investment professionals, and you'll probably make better decisions.